Dear listeners, welcome to this climate finance training kit presentation organized by the NDC Action Project. We'll start out by a general introduction to climate finance. So we'll take you through some definitions of climate finance, different flows and different sources of climate finance, a variety of financial instruments, not only dedicated to climate finance, but usually used when we look at climate finance for different climate policies and measures, and round off by looking at some of the main financing principles that we talk about when we deal with climate finance. So looking at the definition of climate finance, first of all, there is no clear agreed upon definition, internationally agreed upon definition. So there can be different ways to look at it and interpret it. We can look at financial flows from developed to developing countries for climate change mitigation and adaptation activities. There is a general understanding, and it's also written down in international climate agreements, that there is an expectation that financial flows will go from developed to developing countries to finance climate action and to respond to the impacts of climate change. But this definition doesn't necessarily recognize national efforts in developing countries and the finance sources and flows that stem from developing countries for climate action. Others look at the incremental or additional investments beyond business as usual scenarios. We'll come back to this concept of business as usual scenarios in later presentations. But in this case, it's hard to track incremental support for climate compared to regular official development assistance. And as climate has been mainstreamed into general development assistance, it's sort of hard to identify the incremental component of climate support. And also, if you look at incremental costs of investments, so basically the initial higher capital expenditures for climate technologies compared to more carbon intensive technologies, usually we see that climate technologies are more capital intensive, but they also might have lower lifetime costs. So this approach is also challenging because there are some aspects that are left out. We'll come back to the topic of incremental cost also later in other presentations when we describe other aspects, so the cost benefits and so forth, and also when we talk about the principles of climate finance later in this presentation. Another approach or definition is to choose to look at all climate-related investments. So talking about both public, private, and both from national and international sources. And this is actually the sort of most commonly used approach in the context of the UNFCCC. Also when we do reporting to the UNFCCC, and also when there is analysis done by international institutions that seek to map climate finance, also in the context of sort of global trends towards low carbon investments. But still, I mean, under this approach, it can still be hard to differentiate the climate commitment versus development or other regular finance sources. But we will look at climate finance through a lens using this last definition, but we will touch upon some of the aspects of the other definitions also in the presentations. So when we look at the UNFCCC context, we don't only look at concessional finance, not only grant finance, not only incremental cost finance, and not only climate finance coming from dedicated climate-focused financiers like climate funds like the Green Climate Fund and other climate funds. We also look at the leverage of other instruments such as guarantees, and we will get back to instruments later on. And also we look at instruments that can turn future cash flows into upfront financing. So we'll talk about this concept also in some of the next presentations. So the definition that we apply here is basically finance that is consistent with reducing emissions and enhancing sinks of greenhouse gases and aiming at reducing vulnerability and maintaining and increasing the resilience of human and ecological systems to the negative climate change impacts. And in the next slide, I'll go more into details about different sources and flows. And now we will look more at the climate finance flows and the sources. This figure looks quite complex, but you don't need to dwell too much on it. I'll take you through it step by step. Well, first of all, it's a figure up to the right top corner. Basically shows that climate finance flows have been increasing in recent years, increasing steadily over time, and now standing in 2018, at least there were 653 billion annually. And what the figure to the left shows is 4 different columns where we have the climate finance sources on the left column, then looking at the instruments provided, the financial instruments provided in the second column, then the scope of the funding, so looking at adaptation, mitigation of dual purpose cross-cutting, and then finally the sectors that the finance goes towards, what type of actions they finance. And a range of trends emerge looking at this graph. Well, first of all, we see that private investments from, especially from project developers, corporations, and commercial banks, they account for, by far, the major share of climate finance flows. And this highlights the need for climate interventions, so our projects and proposals, to seek to be bankable, to attract private investments. And we will come back with this concept of being bankable, but basically they need to be successful in attracting considerable amounts of private finance, and this emphasizes that it's difficult to mobilize grant-based climate finance for climate investments, for large-scale climate investments. And grants are usually used for other purposes like technology development, capacity building, initial pilot actions, and so forth. This figure also shows that investments in renewable energy are the largest beneficiaries, so renewable energy is the largest beneficiary of total climate finance flows. It also previously used to be the largest beneficiary of public investments, but in recent years, this has been outpaced by investments in transport for public investments. And this sort of trend illustrates how the decreasing cost of renewable energy has led to a shift in financing from the public sector to the private domain, and how public investments are then redirected towards sectors or technologies that are still in need of more sort of risk-willing support to become bankable. We can also see that adaptation finance is eclipsed, so way less than finance for mitigation. And public sources of finance for adaptation are the largest proportion. And this illustrates that adaptation interventions do not provide many options for 100% bankable investments yet. So there is not necessarily good enough returns on the investments from a sort of commercial perspective, but it might be from a sort of social and sort of national perspective. And in many cases, adaptation is still dependent on public and grant financing for implementation. We can also see that most financing comes from within the countries themselves, and this accounts for both public and private finance. And therefore, it is basically important to involve the local stakeholders, the local financial institutions and corporations as much as possible when we decide climate interventions, as these are the ones that we can expect to provide the largest bulk of the investment needed for our interventions. We can also say that see that public funding is a large contributor to investments in energy efficiency, land use, and also the projects with cross-sectoral impacts. And here, both domestic, bilateral, and multilateral development finance institutions account for most of the public finance provided, with especially national development finance institutions being the largest providers of climate financing amongst all the development finance institutions. And this basically highlights the importance of involving the national development banks when considering financing climate interventions that are in need of sort of additional or more concessional finance for their implementation. We'll come back to these aspects of concessionality during the principles of climate finance. We can also see that grants only account for a very small proportion of total climate finance, and almost all grants originate from public sources and mostly have public recipients as their beneficiaries. And grants tend to focus on geographies and sectors that are currently underserved by commercial finance. So as we look at transport, agriculture, forestry, land use, and natural resource management. Debt, so loans, in most cases, is the most important financial instrument. And concessional, so lower cost debt, we'll come back to concessionality later, almost completely originates from public sources, with especially development finance institutions providing the bulk share of the concessional loans. And the second most common type of instrument is equity, and basically direct investments from own resources into a project or activity. And all of this shows also basically illustrates some of the trend, also can help you assess how your intended project or intervention should be best matched made with which financial instruments are you looking for, and what sort of sources of climate finance you should start to interact with or consider to interact with to attract funding for your activity or finance for your activity. But before we go into the instruments, we'll look more about the dedicated climate finance sources. We have over time multilateral climate funds that have emerged, and they finance, they provide are in many ways what we think about when we talk about climate finance, even though here we look more broadly also at private investments and so forth. And as we showed in the climate finance overview in the earlier slides, they only represent a small proportion of all the international climate finance flows, but they're although important providers of finance for climate action, especially when we look at finance outside of normal market conditions. So they can play a crucial role in leveraging additional private finance, and also to sort of lower the price of financing. And amongst these funds, we have the Global Environment Facility, the GEF, as one of the oldest one, which was established in 1991. It is an operational entity of the financial mechanism of the UNFCCC and the Paris Agreement, which means is one of the official sort of sources of finance that are acknowledged by the UNFCCC towards climate investments and that support countries for implementing climate action. The GEF works through accredited agencies to implement and execute the projects, which means there are sort of pre-selected agencies that countries and projects and programs need to work with and through to implement project financed by the GEF. The GEF also administers the Least Developed Country Fund, which has an emphasis on supporting least developed countries and also adaptation plans of actions. It also administers the Special Climate Change Fund, which targets key sectors for adaptation and technology transfers. Then we have a fund dedicated to adaptation, the Adaptation Fund, which also serves the Paris Agreement in assisting developing countries in building resilience and adapt to climate change. The Adaptation Fund was the fund that pioneered direct access to climate finance for developing countries through national accredited implementing entities, which is also the case now for the Green Climate Fund, so the GCF. This is also an entity of the financial mechanism of the UNFCCC and the Paris Agreement, and has just become the largest contributor of climate finance to developing countries. It implements projects through private or public, non-governmental, subnational, national, regional, or international accredited entities. So both national, regional, subnational, and international institutions can become accredited and implement projects with GCF funding in collaboration with governments or other stakeholders. There are also other dedicated climate funds, like the climate investment funds, which are managed by the World Bank and operate through the regional development banks. The regional development banks include the African Development Bank, the Asian Development Bank, European Bank for Reconstruction and Development, and the Inter-American Development Bank. And the climate investment funds, within them include the Clean Technology Fund and the Strategic Climate Fund. The Strategic Climate Fund is again composed of 2 different programs with a specific focus. You have the pilot program for climate resilience, which provide grant finance up to 1.5 million US to prepare a country's strategic program for climate resilience, and also grants and loans to cover costs associated with mainstreaming climate resilience into investments. You have the Forest Investment Program, which support countries' REDD efforts, so looking at forestry, that basically actions that promote sustainable forest management through, and they usually do this through grants, concessional loans, guarantees, or equity. And we'll come back to these instruments later on. And then you have the Scaling Up Renewable Energy Program for low-income countries, which finances renewable energy initiatives through grants and other concessional financial instruments. So as you can see here, there are multiple climate funds with different scopes and access modalities. And because of this, it is important to scout for appropriate support providers and financiers early in the process in order to basically identify a good match in terms of the scope of your project and program. And this matchmaking enhances the probability of accessing finance. This is just a representation of some of these funds and provide some more information to understand the scope and coverage. We have on the top left a table that presents how different funds can be accessed. For the GCF, there is a first come, first serve approach. The fund is financed mostly by governments and then replenished when there are needs for additional funds. And basically, there is a first come, first serve approach. And there is an increasing focus on country programs so that countries make plans of engagement with the GCF and have a sort of a priority list of the climate actions they want to implement. So therefore, when approaching the GCF, it's important to look at the sort of country program and existing interaction between the country and the GCF and make sure that there is a good fit between what we propose in our projects and programs and the country programming. So the priorities of the countries that they have communicated to the GCF. For the GEF, so the Global Environment Facility, there's actually an allocation of funds to the different developing countries, which is predictable. And there are also allocation for different environmental purposes, but there is one dedicated for climate. And countries basically can access the funds that are allocated to them, but still need to provide a sort of proposal for the specific project or program. Then for the climate investment funds, the access happens through the multilateral development banks. So reaching out to the development banks is important here to be able to discuss and align your projects and programs to sort of the priorities of the funds, but also to the access modalities of the banks. For the GCF, the instruments that they applied are multiple. They have everything from grants to loans to guarantees and even equity. For the GEF, it's mainly grants, and all the use of the different instruments also puts a sort of a limit, I would say, or restrictions on the amounts that we usually receive or see that these funds support. And for climate investment funds, there is a wide variety of instruments as well. So this is reflected into the figure to the bottom right. We can see on the x-axis the sort of size of the investment, and on the y-axis we see the number of projects. And this basically says how the funds that usually operate with grants, they maintain sort of smaller size projects in terms of funding volume, but like the GEF, which has been operational for a long time, finances a lot of projects, while the other funds, which provide other instruments and especially debt, are able to finance larger projects in terms of funding volume, but usually maintain a lower amount of projects that then are financed. And this is a very complex slide, and it's not something you need to delve too much into. It's just to illustrate that the funds presented earlier are not the only sort of public financed climate dedicated funds. There are a variety of climate funds and climate finance sources from the public domain. And this is just an overview of the different sources and how they finance specific funds and initiatives. So it's an ecosystem, you could say, of different funding sources and initiatives. And usually, when you have a project or program, you will be able to find a match between what you're proposing and some of these funding sources. But it's important to then delve a little bit more into what the access modality is, potentially which stakeholders you will need to interact with, and what you can expect. So looking at what your needs are in terms of financing and matchmaking with what the different initiatives or climate funds then provide. So I've talked about the instruments, and here we'll look more into details on different instruments. I'll start with the most common ones. We have grants, which is basically money that is provided without any expectation of being repaid, and but they usually still comes with strings attached, meaning that when we look for grants for climate finance sources, of course, the climate rationale that I mentioned earlier, but the different climate funds also have their own requirements for it can be environmental and social safeguards or access modalities or other aspects. The advantage of grants, of course, is that it's free money. You don't need to pay back. You can also have reimbursable grants, but basically it's not debt. So this is money that you can spend without having to return it. But at the same time, as mentioned, grants are very few, and the amounts that are usually provided through grants are lower than for other instruments. And usually they are not used to finance activities where there is an expectation of having positive cash flows during the lifetime of the intervention. So again, maybe relevant for adaptation, for pilot projects, for capacity building, for technology development and so forth, but seldom used for investments in technologies. Then we have concessional loans. So I talked about loans. Most people know what a loan is. Concessional loans is basically a loan that is provided below market rates. And and when we say below market rates, it can be looking at the interest rates, it can be looking at the repayment periods, grace periods, or a combination of these aspects. And of course, the advantage of a concessional loan is that it lowers the cost of finance for interventions. So interventions that were not bankable under market rate conditions might become bankable and enter then the market with concessional finance. But at the same time, we also need to make sure that we're not distorting the market. And we also need to make sure that we're not sort of over subsidizing certain technologies. So concessional loans also need sort of a justification for why they are provided. Then we have guarantees, and guarantees are also an effective instruments in lowering the cost of finance. Basically, a guarantee, it can be a climate fund, or it can be something similar to insurance, basically goes in and guarantees from that the loan will be repaid in part or in full, which lowers then the costs of finance. So basically making the loans concessional because the guarantee is provided. It can come with fees, it can come without fees, but it's a very effective instrument at lowering the cost of finance. And in some cases, especially where banks see the proposed activity or technology in the specific context as having a high risk profile, they might not even provide loans, and a guarantee can then, in many cases, even unlock finance that was not earlier provided. And we have equity, which is basically in direct investments, so injection of capital to grow operations in a project or an activity. And equity usually comes from private sources, but there are also funds that can provide equity. And this is sort of the most common project finance along with loans. So you have private or public sources that finance the project themselves with direct capital injection. And usually banks would require a share of equity going into investment. So we seldom see that banks finance 100% of investments or capital expenditures with their loans. So there usually is a requirement that the proposer or owner of the project also takes a part of risk, or other investors are also on board. Then we have the more complex instruments. We talked about loans, and mezzanine finance basically is a loan or loans where, in the case where there are a multitude of debt finance providers, so it can be, for example, a multilateral development bank and a commercial bank providing a loan for a project or program. It's an agreement between the various finance providers about who gets then paid back first in case there is a default. We can also talk about junior and senior loans to describe the relationship between these. And an example could be that if, let's say, the Multilateral Development Bank agrees to be paid back later on in case of a default, if there are money left from the assets that are left in the initiative, while the commercial bank gets paid back first, it can such agreements can help lowering the cost of finance for the project by the commercial bank as well, because they see that investment as having a low risk profile. Then dedicated credit lines, they are basically debt instruments as well, but they are dedicated for a specific scope. We see banks, financial institutions increasingly having a focus of becoming Paris aligned, or showing that they have increasing green portfolios. So basically means there's certain amounts of funds set aside to target green and climate investments as opposed to carbon-intensive technologies. I have bonds, which is a debt instrument as well, where the investor basically lends money to an entity, and the entity that borrows the funds, they provide a sort of IOU document, which has a fixed period of time and a fixed interest rate. And these bonds can also be traded openly in a market. And these bonds are also a good way to leverage finance from multiple sources. And we see governments issuing bonds, blue bonds or green bonds also. So basically dedicated bonds where the leverage finance go towards investing in climate actions, and not only governments, but also it can be other institutional stakeholders. Then we have carbon credits, which have a history already back from the Kyoto Protocol, where carbon credits in the clean development mechanisms were generated by projects in developing countries and then traded to both private and public entities, but basically assisting in meeting climate targets by other stakeholders. So it's basically a certificate of an emission reduction having occurred in one place, which is then transferred to another stakeholder or another institution or government. And this sort of carbon market is not only the clean development mechanism, but this was the most known one in the past. We have a voluntary carbon market, and with the Paris Agreement, we have the establishment of a sort of new carbon market that goes under the Article 6 of the Paris Agreement. So countries and entities are allowed to trade in these carbon assets, and they can go towards financing climate action. Then we have also something called debt for climate swaps, which is basically an instrument, we can call it that, where debt relief is used to finance climate action or environmental action. So looking at the debt that is already in place, usually for a country, and it can involve the sale of bonds or the repurchase of bonds at a lower price to then the money saved from servicing the debt is then used for investments in climate action. Here is an overview again of the different instruments of the different climate funds. We see that the Global Environment Facility, as mentioned again, provides grants. The same does the least developing country funds, the Special Climate Change Fund, and the Adaptation Fund. And then the others provide the more multitude set or palette of instruments. So depending on your project and programs, you can look at sort of what is the instrument that is needed for this project or programs to be implemented, and try to target the funds that are the more or the best match to your initiative. So now we'll look at the principles of climate finance. We talked about some of these aspects already. So concessional loans. So what is concessionality? As mentioned, the level of concessionality expresses how soft the financial terms of the instruments are. So below the market terms. And the rationale for this is that basically climate action in some cases needs to be helped to be able to compete with the technologies that are usually applied, the more carbon intensive technologies. And here climate finance institutions can provide concessional finance to facilitate like high impact climate actions which would then otherwise not take place. We usually talk about de-risking the investments. So especially in cases where commercial banks deem the investments too risky, and meaning that they either don't provide finance or the cost of finance is too high, then climate finance institutions can help in lowering the cost of finance, either by providing various instruments themselves or through guarantees, which is also an instrument to unlock commercial finance. But of course, the climate funds available are scarce, so the climate finance institutions also seek a minimum of concessionality, not only to sort of most effectively use the funds available, but also to make sure that you don't over-subsidize a specific technology or sector. So it's important to make an argument in your projects or proposals about why the specific level of concessionality is requested. It's basically describing why what you're seeking is the minimum concessionality needed to make the investment bankable without distorting the market. Then it's important to note that, so basically, as you show that why this is the exact minimum concessionality needed, means also that concessionality is determined on a case-by-case basis. And when we talk about grants, this is an instrument with full concessionality, and is usually used to finance things as technical assistance, capacity building, as mentioned. It can also be used to finance pilot projects or similar. And then when we have a partial concessionality, we look at aspects like lower interest rates, longer payback times, first loss, and so forth. And usually for highly viable investments or bankable investments, like certain renewable energy technologies in certain markets, we cannot expect any concessionality because we know that the technology is proven and can compete on the regular market terms with others. This is an example from the Green Climate Fund on concessionality. So looking at two different type of loans, one with high and one with low concessionality, we can see the maturity, so the years expected to be paid back in 40 years for high concessionality versus 20 years for low concessionality. I think in general these are quite long terms as well. Grace periods, so the periods in which you don't have to start paying back can be 10 or 5. The principal repayment can be 2 or 6.7. Interest rate of even down to 0 to 0.75. Difference in service fees, difference in commitment fees, and so forth. So this shows how different levels of concessionalities can be applied for different types of projects. Another concept or principles is the co-finance, which means that we cannot expect the funding source to provide all the finance needed for the investments. So project proposals should seek to incorporate an appropriate level of co-finance, also to maximize impacts of the resources from the finance institutions. So the financial institutions would ideally like to see that they provide the finance needed to getting other financial sources engaged and provide the funds that are available to them. And this is just, again, an example from the Green Climate Fund, where there are different levels of co-finance requirements, or at least here is from the portfolio and the implementation at the time this figure was provided. We can also talk about different types of co-finance. We talk about direct co-finance. This is where public and private resources provide finance directly to the project together with Green Climate Funds funding. In this case, we can talk about indirect co-finance, where there are other parties that provide finance into a project or into the sector, but where there was not necessarily in this case, the GCF funds who triggered them to make the decision to invest in the technology or sector or project. We can see leveraged or mobilized. In some cases, we also talk catalyzed climate finance. It's basically the investment that comes because the initial investor has invested their funds. So, or it can be a guarantee that is provided to commercial banks for investments in a given technology. And because of that guarantee provided, let's say $1 million, the banks have provided $10 million of loan available for implementing a certain project or a certain technology. So those would be the mobilized or leveraged co-finance. While the direct would be the GCF provides 50% of the loan funds needed for a dedicated project, and a bank provide the other 50% for that specific project. And sequence is basically co-finance along with the funds sources, but there is no causal relationship. They're just funds flowing into the same direction. And I mentioned incremental cost earlier, and basically it's the additional expenses to produce the outputs that we seek, the climate output that we seek. In this example, in the figure is basically shows the difference of costs for power generation when we look at coal versus solar, and the gap in between them is the incremental cost of the climate technology. Now, the coal would be the business as usual costs that we operate with, and the solar PV here is the counterfactual scenario, so that shows the incremental costs. But the incremental cost is not only the sort of initial capital expenditure, because we know that climate technologies in many cases have higher capital expenditures, but in many cases they also have lower operating costs during their lifetime. So we also need to look at the net costs. So incorporating the net benefits, the benefits from the project and the mitigation and adaptation impact that we subtract then to the initial sort of incremental cost that we have identified looking only at capital expenditures. And then on top of that, there can be other costs related to capacity building and so forth that can be added to that as a need to making the project or implementation of the new technology implemented. And we can look at the full costs when we add the net costs and these additional expenses. So we need to first look at the capital expenditures difference, and we need to look at the lifetime benefits, and we need to look at the additional needs that our projects and programs have for them to become viable and bankable, and then get an overview of what the sort of full incremental costs of our projects and programs are. And that is what we usually request funding for. And here we basically show this time-wise perspective of capital expenditures versus lifetime costs. So in the example here, the climate technology has a higher capex and lower opex over its lifetime. So this is also an aspect that we need to consider when we design our projects and proposals. We need to ask for the right amount of funding to enable us to make the initial investments and get the other financiers on board, but looking at the whole lifetime of the project as well. So what does it take to make the financiers or the investors willing to invest in these new climate technologies or practices? And this is, again, a GCF example of the relationship between incremental cost, concessionality, and co-finance, these principles that we have touched upon. So we look at the project with the total cost of 100 million. We then look at the incremental. They have dedicated methodologies to define that, look at the incremental costs, and then the GCF might be willing to finance 60 million, which is they see as climate-related part of the investment and partially covering incremental costs of the action. The 40%, which is not deemed as climate-related, would have to come from somewhere else. Then they use a concessionality, their concessionality guidance to assess the level of concessionality needed for the investments, and based on that, it's decided how much is the proportion of grant and how much is the proportion of loan to make the investment viable, and then the remaining 40 million climate related will have to come from other sources. So co-financing, it can be from the government, from other investors, and so forth. And with this, we end the first presentation, so the introduction to climate finance. I hope you have a clear understanding then of what climate finance is or what it can mean to different stakeholders, where climate finance can come from, so sources, and where it usually is directed, and which financial instruments are applied, and also that you have an understanding of sort of the principles of climate finance that are important for climate finance providers, and how to consider a matchmaking between your project or proposal with different potential funding sources. Thank you for listening.